If you look at wealth building from the outside, it feels like there's a cover charge you can't afford. A lot of us get paralyzed waiting until we have 100,000 pesos sitting around, thinking that's the absolute minimum to even start. We've been sold this Hollywood version of investing. It says you need massive capital, perfectly timed stock picks, and you must watch the market sweat every single day. The reality on the ground today is entirely different. You can build a resilient portfolio right now with a single 10,000 peso deposit, or by setting aside just 1,000 pesos a week. That's due to the rise of unit investment trust funds, or UITFs, and automated digital platforms. They let you pool your money into globally diversified funds with a few taps on your phone, and then completely forget about it. Most people wait for a significant bank balance that never arrives. The real cost of starting late is the compound interest you lose while waiting to feel ready. When you turn on financial news, it's a sensory overload of hourly ticker updates, tech earnings reports, and geopolitical panic. It makes investing look like an intense, full-time job. If you're managing your budget carefully, that constant anxiety is exactly what keeps you away. It feels way too complicated on a Tuesday night. Asset managers like Atram and Manulife now provide digital entry points, with minimums as low as 1,000 pesos. This shift allows you to funnel small capital into professional funds without touching a trading floor. We will break down exactly how to deploy those micro-contributions over a multi-year horizon and look closely at the specific trade-offs and mechanics involved. This strategy moves the focus away from reacting to news and toward executing a repetitive, automated schedule, a system designed to function regardless of what the headlines say. This chart shows how the system works. Start with 5,000 pesos, adding 1,000 weekly across 4 funds. You get continuous global market exposure. When the market dips, your fixed input automatically buys more units. You stop timing the market entirely. The price for this automation is absolute discipline. You commit to those weekly deposits over a multi-year timeline, regardless of what the market does. And that leads to the main psychological trap of this method. With small capital, you won't see massive absolute dollar gains in the first 12 months. We are conditioned to want the massive payoff from a single lucky trade. But micro-capital growth is intentionally slow and methodical. You are trading the fantasy of overnight riches for a mathematically sound, realistic strategy to get your money working in the global economy. This matrix shows the split between high-risk individual stocks and diversified UITFs. The UITF route provides curated access to massive global shifts, like tech, infrastructure, and real estate. However, this access costs ongoing management fees for professional oversight. You also completely surrender control over which specific companies you own.
You defer entirely to the fund manager's discretion. Because you're buying into a broad sector, you absorb the volatility of that entire industry. If one specific company underperforms, you cannot just pivot your money out. Utilizing these feeder funds means you are paying for professional oversight and global scale, and the explicit cost of that is your own granular control and those management fees. To make this strategy work, we apply a very specific execution framework: 3 years of active accumulation followed by a strict 3-year hold. The goal is to build a heavy, diversified base of capital passively, and then lock it in so the accumulated mass can compound untouched. Committing to a hard 6-year timeline acts as a circuit breaker. It stops you from logging in and panic selling everything during a bad news cycle. The severe trade-off here is that your capital must be treated as functionally illiquid. You cannot touch it for half a decade. If a financial emergency forces you to pull this money out in year 2 during a market downturn, you will actively lock in a loss. That makes this entirely different from a high-yield savings account, which is built to give you immediate access to your cash for an emergency. True wealth compounding requires treating your investment capital as off-limits. You have to accept illiquidity as the required price for long-term growth. This scorecard helps us map out exactly who should actually deploy this 1,000 peso weekly strategy and who needs to stay away. The ideal candidate is a young professional, a budget-conscious beginner, or someone with a reliable income who simply doesn't have the time to optimize their finances. They want structural exposure to major global trends, like semiconductors or real estate, but they have zero desire to sit down and analyze daily price charts. On the flip side, this fails completely if you need a short-term parking spot for an emergency fund. If you can't afford that multi-year lock-in mentality, this isn't for you.
It's also the wrong fit for anyone trying to beat the market or chasing the thrill of picking the next big tech stock. Micro-investing offers no quick wins. It is a highly mechanical, methodical process designed strictly for people willing to wait. Building a portfolio from scratch ultimately comes down to consistency and time, not access to massive upfront capital. Starting with a 10,000 peso deposit or setting up a 1,000 peso weekly rotation is mathematically sufficient to secure your position in the global market today. You just have to accept the trade-off. You give up immediate returns and individual stock control in exchange for a slow, automated buildup. The reward for accepting that trade-off is immediate professional management, actual global diversification, and complete immunity to daily market stress. The structural requirements for high capital entry have effectively dissolved. A simple, automated contribution is now all that's required to start the clock on long-term growth.